cash flow. We have a lot of influencers in the real estate space that are like, dude, real estate is not a cash flow play at all. You're smiling because you're probably you hear this, especially recently with the rates. So here's the funny thing is that everyone's talking 2 years ago, like, bro, it's cash flow business, but now rates are up. And they're like, oh, actually, it's not a cash flow business. Create a real estate related actual business instead of making cash flow from the rentals. So I'm just curious. I just want to, go down this rabbit hole real quick.
Yeah, it's an interesting rabbit hole. I've heard a lot of talk about this, and the more I hear, the more I've kind of internalized the conversation about looking at the numbers and really mapping out what's going on. I've had the luxury of buying real estate, started 18 years ago, so I've got some pretty seasoned debt on properties, and so from experience, I can tell you almost a couple decades going by, it's very challenging to generate true cash flow. When we underwrite a deal, we're truly building in all operating expenses. We're factoring in the repairs and maintenance. We're factoring in management. We're factoring in, the taxes and insurance and CapEx. And what's left over in theory is cash flow. It's hard to predict what could come up. And what I've kind of learned to accept is that in time, the cash flow is really how cash flow is generated. The longer you own a portfolio, the more you're going to be able to actually reap some of the benefits of having cash flow. And that's kind of the traditional method of purchasing. If you were to just base your strategy off of buying real estate with bank financing these days, even if you're buying at 50, 60 cents on the dollar, we're still seeing a major gap in the ability to generate true cash flow day one. The way that we are doing it right now is through seller financing. And with that strategy, we've been able to outcompete corporate buyers like Open Door and others who are offering very high numbers, cash numbers on properties that, we're also bidding on, but it helps us bridge the gap between bid and ask. We can actually afford to pay a seller their asking price or closer to their asking price, or even a premium. Like we've paid more than a property is worth. This has been a recent shift in my thinking of the past few years. And how we do that, how we can justify that is by, having the right seller who in trade for price will give us terms that are very attractive for us. And so, it's a terms game. And, so for me, I'm a cash flow investor. Like that's truly what I'm seeking. Like we want to generate enough cash flow, positive cash flow after all of the expenses that we've talked about to be able to replace income on multiple businesses. So I think it's an offensive play, but I do think that it is viable with the right knowledge on how to craft a debt structure that allows a seller to get what they want and for a buyer to be able to get what they need out of it. There are some properties that I've had that I think it's just like owning a business, like any business. Some properties it's important to really take a look at the portfolio to see what the actual rate of return is, and you carve out the ones that aren't really performing well. And, I've heard some gurus call them like little piggy banks. So I think it's a very interesting concept and it's like a little piggy bank that you could crack open and roll it up into something else. But we are actually seeing true cash flow right now on some of the deals that we're putting together through seller financing.
Well, let's walk through that and let's talk about seller financing, because when I asked Ramon when he came to the private dinner, I said, Ramon, besides business stuff, tell me something that Robbie just loves to talk about. He goes, I don't know. All we talk about is seller finance. I'm like, that is your love language.
It is, dude. My wife does not have the same love language, so she's over it. But yeah, seller financing is it's where it's at. The market right now is
break it down really simply for the audience real quick. Seller financing, because there's lots of different types, right? There's wraps, there's subject to. So seller financing in general, what is it? And then break down how you structure it.
It's kind of just an umbrella term for being able to make terms that where the seller becomes the bank, right? A true seller finance, in my mind, is a property that is owned free and clear by a seller. There's no underlying debt. You truly make them the bank. And so instead of going out to your local community bank and getting a mortgage, all we're doing is we're negotiating terms for the seller to be the bank, and we make that payment directly to a seller, usually through some type of servicer, an escrow company or a servicer, and then they get a principal and interest payment, and usually there's some type of interest rate in some cases attached to that. So they're generating a return on the loan amount, and we just pay them instead of a bank. So that's essentially what seller financing is. And there's different types of structures that you could put together. If there is a mortgage on there, we could do a wrap of an existing mortgage with a higher balance than what is actually owed. So there's a little bit of equity between what the seller owes and what you owe. We can do a dollar for dollar wrap, which means that you're just stepping into the seller's shoes on their payment without actually assuming it. it. Still a wrap. The favorite ones, my favorite is the one where, you have a seller who's very sophisticated and understands, they've got an asset and they want to be the bank. We create a stream of income for them. So we get rid of the tenants, the toilets, the termites, all of the noise that being a landlord encompasses. And we give them true passive income in the form of a monthly payment. And the reason I like that the most, Jesse, is because there's no deal that won't pencil if there's no constraint on having some type of mortgage in place where we got to make sure that the balances are correct and the payments match up. And that's how we're able to put some really exciting deals together.
I don't know. How many are there in America where it's just free and clear homes? Probably a lot more than I think.
There's a ton.
Really?
What I've heard, don't know that this is exactly true, but I've heard from multiple sources that there's more now than ever. The statistic that I heard was about 40% of the homes in the United States are free and clear. So there's that interesting statistic. Whether that's accurate or close to, that's very exciting. That's the opportunity. The other exciting opportunity is that 60% of the outstanding mortgages have a 4% interest rate or lower. So even when you have a seller who has debt on a property, many people originated a loan back when the rates were more attractive. Another incredible opportunity to give a seller what they're looking for and getting in return some terms that work for us. It's a true win-win negotiation.
I love that. Let's just do a little role play because I just love to give something tactical.
Okay.
So if there's a caller, one of your people or even you call a landlord, what would you say to kind of like pitch them on seller financing and doing terms?
One of the first things that we ask is, I let them know that when we make offers, typically what we do is we make a cash offer. That's how we're having a conversation. It's not very common that we come out and say, hey, this is Robbie. I'm interested in buying your real estate with seller financing. Are you open to that? It's, hey, you want to sell? Of course, there's more to it than that conversation. But when we get somebody who's actually interested in it, one of the first questions that we ask once we have somebody who's definitely ready to make a yes or no decision, we know that they want to sell, is we ask them very simply, like, do they have a need for the money? Let's play this out. If I pay you cash, we have an agreement on a fair price, what are you going to do with the money? We find that more often than not, there's not plans around that. And truly, there's more exposure for a lot of people having cash. There's tax implication, right, on a capital gains in the event that they own it as an investment property. There's a tax implication on that. There's some issue potentially with having too much liquidity in a bank where we have in a high inflationary environment. So for them to remain as almost a partner, so to speak, in a deal where they have an asset that they're comfortable with because they know it so well, selling to a viable buyer and where they can generate a return on the balance owed to them. That worst case scenario, I fail, they take back a property that they have some familiarity with. And we find that when you navigate that conversation the right way, a lot of people can be receptive to it. I will say that what Ramon and I are doing is we're negotiating terms that work for seller and buyer. A lot of times for us to generate cash flow, we have to have some type of upside in making the payment very attractive, especially when we're paying a higher sales price. So how do we do that? We're stretching out the amortizations, which is actually more beneficial for a seller, meaning we have a longer time period to pay back that money, so less money goes towards paying it down every month. The sellers like that because they're getting less principal payments per month, but that's an option. The other thing that we typically go for is an interest rate that allows us to generate cash flow. Now, when we make these negotiations, an interest rate does come up. It's usually one of the first things that a seller wants to know. We negotiate based off of payment and we back it up with logic. So instead of saying, I'm going to pay you 6.5% interest on the balance, is that okay with you? Like, we're doing the math on this, building out a true underwriting, factoring in all the expenses, and then we can understand on our end before we talk to the seller, what's the maximum amount of monthly payment we can afford to pay a seller. And when we present it, we use logic. Based on the price that we're giving you and the down payment that you're looking for, I need you to understand that as an investor, we just need to be able to generate a return on our investment. So the way that we're doing that, because we're giving you your price, is we have to have these terms work for us. So we could pay you $1,000 a month in principal and interest payment. What does the interest rate come out to? We'll do the math on it and I'll show you, but I just need you to understand, here's why. And then we dive deep into very transparent. These are our operating expenses. It rents for $2,000. We pay you $1,000 a month. We don't get the delta. We don't pocket $1,000. We actually get more like this number because of all of our operating expenses. If we're paying you $10,000 down, $20,000 down, we have to be able to justify a rate of return on that money. And it needs to make sense for us to allow you to get the benefits of that rather than just putting it in a high interest savings with no risk at 4.5% right now. Does that make sense? Just having a logical conversation around it and really meeting their objectives, understanding their goals is how we're able to negotiate good terms.
Do these sellers look like a certain type of demographic or like an audience?
We find it's very interesting that you asked that. Some of the best deals in terms of really good terms and payment structures that we've been able to negotiate have been with people who are very sophisticated. They're very savvy. They understand seller financing, and they understand it's a mechanism for them to get a lot of benefit after avoiding some potential gains on the investment properties. And they understand that there's a lot of security there. The avatar is truly like the best deals are the people that own more than one property and have a lot of experience owning real estate. And it really just makes it for a very reasonable conversation when you can just very plainly just show the math behind it. And they're investors also, like they typically, not always, but they understand that there needs to be something in there for the buyer.